Welcome to Mentor Nova. Today, we are going to audit the most universally praised personal finance book of the last 30 years, Rich Dad, Poor Dad. If you are looking for a way out of the daily corporate rat race, this is usually the first guide you are handed. The appeal is obvious. Robert Kiyosaki built a massive empire, selling over 26 million copies globally, all by sharing the unconventional wealth-building wisdom he supposedly learned from a highly successful childhood mentor. But as you dig past the motivational quotes and look at the actual math, a serious tension emerges. Certified financial planners, real estate analysts, and investigative journalists have been issuing stark warnings about the text for decades. They point out that the book contains severe historical inaccuracies, and far worse, specific tax strategies that could literally land a reader in federal prison. To understand how a book can be simultaneously brilliant and highly dangerous, we are going to audit Rich Dad, Poor Dad using its own golden rule. We will separate the psychological assets that make this book a classic from the tactical liabilities that could ruin your finances. Let's open the assets side of the ledger. Kiyosaki excels at bypassing complex accounting jargon to change how you view your money. This animated diagram shows a pocket with green arrows representing cash flowing downward into it. In Kiyosaki's framework, an asset is simply anything that puts money in your pocket, whether you work or not, like a rental property, a small business, or an index fund. Conversely, a liability is anything that takes money out of your pocket. Even things traditionally considered assets, like a brand new car financed at 8%, or an expensive primary residence with high maintenance costs, are liabilities if they keep cash flowing right out of your bank account every single month. To acquire actual assets, the book preaches the concept of paying yourself first. By automating 10 to 15% of your income directly into a savings or investment account before paying a single bill, you force your lifestyle to adapt to the remaining cash, rather than hoping to invest whatever happens to be left over. Once you secure that capital, you have to completely shift how you think about earning. This animated 2x2 grid shows Kiyosaki's cash flow quadrant. The left side holds employees and the self-employed, who trade their physical time for a paycheck. True wealth requires migrating to the right side, becoming business owners and investors who deploy capital and systems to do the heavy lifting. These psychological reframings are massive assets. They successfully break readers out of a heavy consumer mindset, forcing them to look closely at their cash flow and stop buying depreciating items disguised as investments. But when we shift over to the liabilities side of our ledger, we have to start by questioning the foundation of the book's authority, the true identity of the rich dad mentor. The entire narrative relies on a wealthy Hawaiian man. He is a fictional composite character, constructed from the traits of several different people to create a convenient marketing fable. The origin story is highly fluid. In earlier writings, Kiyosaki claimed his biological father was the greatest teacher he ever had. By 2006, he shifted again, claiming the famous architect and systems theorist Buckminster Fuller was actually his ultimate mentor. Fables are excellent tools for motivation, but when millions of readers treat a fictional story as a literal autobiography, they lower their defenses. They begin trusting the specific, tactical financial mechanics embedded in the story, mechanics that are completely divorced from reality. The book heavily pushes the idea that traditional education is a poor dad trap. However, labor statistics show that average college graduates earn over $1 million more throughout their lifetimes than those without a degree. Dismissing higher education ignores the very real return on investment it provides for the vast majority of the workforce. Then there's the famous claim that your primary residence is a liability. While it is true that houses carry hidden maintenance costs, calling it a strict liability ignores the fact that a paid-off home provides immense security in retirement. For millions of middle-class families, forced monthly mortgage payments translate into their single biggest wealth-building tool. Take a look at this line chart mapping a typical highly leveraged rental property in a modern economy. We have a stagnant green line for rental income, but a rising red line for interest and maintenance costs crossing straight above it. Kiyosaki advocates using heavy debt to buy properties, but in a high interest rate environment, one vacant month or one major plumbing repair will push that red line so high that the bank can and will foreclose on the everyday investor. But the worst advice arrives when the book discusses taxes. the text strongly encourages readers to set up a corporation so they can pay their personal living expenses with pre-tax dollars. Let me be incredibly clear. According to the IRS, a corporation must have an actual legitimate business purpose. Using a corporate structure simply to write off your personal lifestyle expenses is outright tax fraud, and it carries severe legal penalties. These specific mechanics are massive liabilities to your balance sheet. They expose everyday people to extreme financial leverage, highly concentrated risk, and severe legal consequences under the guise of insider wisdom. When we step back and look at the final ledger for Rich Dad, Poor Dad, we find a heavily conflicted piece of work. It is a phenomenal psychology book. It will wake you up from the daily grind, force you to look at your spending habits, and make you realize that a high salary means nothing if you spend it all on liabilities. But it is a terrible tactical finance manual. Let the fable motivate you to stop buying things that drain your pocket, but when it is time to actually deploy your capital, ignore the fictional anecdotes. Rely on verified modern data. Speak to a certified CPA about your taxes, and look to broad, low-cost index funds to build reliable, long-term wealth. True financial literacy requires graduating past the motivational stories and sitting down to do the actual math. Thanks for watching Mentor Nova, and we will see you in the next audit.